Hey, it's Matt. I want to take a few minutes and go through what after-tax 401k is, if you have that available as a work benefit, and why it's so cool. And the first thing I have to clarify is we're not talking about Roth. So typically in your 401k, you will have the option to defer some of your salary into the account. And you can either choose to do it on a pre-tax basis, which may be called traditional or just pre-tax, or they may not call it anything at all. And then the other option typically is Roth, where you can not take a tax deduction for your deferral into the 401k. After tax is different than that. It is similar in concept to Roth, but it's not the same thing. So I want to go through what it is. It's an unusual benefit. It's an unusual feature, but if you have it, you ought to know what it is and most likely take advantage of it to the extent that you can. So first, let's just think about, I call this a 401k tower. I just want to talk about what the three components of the 401k plan are to sort of help you visualize and understand what's going on here. So the first part that you're probably the most familiar with, to the extent you're familiar with it at all, is the employee deferral. And in calendar year 2023, you can defer up to $22,500. Typically, this employee deferral amount will increase with inflation each year, but for this year, it's $22,500 for the employee deferral. And that can either be made on a pre-tax basis or a Roth basis, just like we talked about a minute ago. Then, if you're lucky, your employer may offer a match. Usually, it is a percentage of your own deferrals, or it's a percentage of your salary up to however much you defer. So you may or may not have an employer match. I'm just leaving a question mark there for the time being. We're not going to fill in a dollar amount yet. And those matches can either be made on a pre-tax basis or a Roth basis. It wasn't until recently that Roth matching contributions became available. And I'm putting it in red here just as a warning sign. It's not necessarily that you should never choose a Roth match from your employer. There may be cases where that is a good choice for you. But for most of the clients that I work with, it is additive to your taxable income when it is a Roth contribution. It's going into your 401k, so it's not money that's really immediately available to you or anything. So it's almost like being taxed on phantom income. It's not. It will become your money, assuming that you survive any vesting schedule. But generally speaking, you just need to really think hard about whether you want to accept an employer match in Roth terms. So that's why that is in red. And usually that's kind of the end of the discussion. You have the employee deferral and you have the employer match. In this case, I'm using some fictional matching data, matching numbers that would get the total contributions between your employee deferral of $22,500 and the employer match. It would mean that you've added about $39,375 to your 401k for that year. And that's wonderful. That's great. That's a lot of money to put into your 401k. But what a lot of people don't realize is that the 401k program in and of itself can actually have up to $66,000 in total contributions. And again, this is for calendar year 2023. And so there may be a significant gap, right? Like if you're lucky enough to receive this large employer match for your 401k, there's still a significant gap here between $66,000 total limit and $39,375 that were contributed. If you don't get a match at all, that gap is even greater. You've been able to defer $22,500, but there was up to $66,000 in space available here. And so why do I point that out? Well, enter the voluntary after-tax contribution that you can make. And so what is that? What you do is you put after-tax dollars. Again, it's similar in concept to Roth, where you're not going to get a tax deduction for the contribution you make, but it is different. You put after-tax dollars into the 401k. That's what the shaded area is. And then those dollars are immediately converted to a Roth 401k or Roth IRA account. So, usually your 401k plan will have the opportunity for you to make these voluntary after-tax contributions and then take the dollars from that voluntary after-tax account and convert them to a Roth 401k account, and or convert them, take them completely out of the plan itself and put them into a Roth IRA. Any growth that occurs between your contribution amount and the conversion is either going to be taxed or it'll be rolled into a pre-tax account. So that's a bunch of words. It's a lot to look at. Let's look at a visual explanation for how this works. So visually, you can see it this way. You can think of, there are really, from a 30,000 foot view, there are three different types of investment accounts. There are tax-deferred accounts or tax-deferred dollars. That's typically like your 401k or, depending on how you use it, your health savings account. There are Roth dollars that are never taxed again, assuming they're withdrawn for a qualified reason. That's like your Roth IRA, or again, depending on how you use it, your health savings account. And then there are taxable dollars. So these dollars, the capital gains that are incurred and or the dividends and interest that are accrued while you have the money invested, those are just taxable in the year they occur. And that's like your brokerage account. And I think I forgot to mention, tax-deferred accounts just mean that they grow tax-deferred, and or you get a tax deduction when you contribute to the account. But once you take the money out, the growth itself is taxed. So, there are contribution limits to the tax-deferred accounts and to the Roth accounts. So for calendar year 2023, the maximum that you can defer in your 401k, for example, is $22,500. And then hopefully you get an employer match, although many people don't. So that's a big if. And then in your Roth accounts, the current limit, if you're under age 50 and no catch-up contributions apply, that's in all these cases, the current limit is $6,500 a year that you can contribute. And then typically your taxable account, there's no limit to how much you can contribute to it. I just, when I was making the slide, called it liquid leftovers, meaning after you've maxed these out, if you have more available to save and that you need liquid, that's what would go here. And of course, everybody's situation is different, and so you may not be maxing out your 401k and or your Roth IRA if you have immediate liquidity needs. But let's just say that you have the ability to max these out, and so you do, and then your taxable account is where any leftover liquid dollars would spill into. What is so cool about this is that there's this limit here for the Roth IRA, and remember, these are dollars that are never taxed again, so they're attractive. It's an attractive place to store wealth. What's so cool is the voluntary after-tax contribution is converted over to Roth dollars. And so in my example, where there was an employer match plus the employee deferral, the range of outcomes could be anywhere between, call it $26,000 and $43,000 in terms of additional tax-free dollars to go in this Roth bucket. And the reason there's this range is because I was using a hypothetical example where there was an employer match. But if there's not an employer match or it's not maxed out or whatever, there can be even more significant amount of money to go into the voluntary after-tax bucket and then be converted over to Roth. Of course, you do want to take advantage of the pre-tax deferral for the employee deferral. So let me get that pulled back up here. To the extent you can, you want to take the tax deduction. If you're in a high tax bracket, you want to take the tax deduction as much as possible. And so you'll want to max out this $22,500 employee deferral opportunity, because you get to count that against your ordinary income for tax purposes. So that's good. But what I'm saying here is, if there is an employer match, then maybe it's, call it $26,000 that you could put into the voluntary after-tax account. If there's not an employer match, then you have all this extra room here that's not currently shaded in, which might add up to around $43,000. So this is just a huge batch of money that can be added to the Roth account, which otherwise, that could occupy 5+ years of traditional Roth IRA contributions just in one single year through this voluntary after-tax account, or it can be significantly more than that. So that's why this is such a big deal. Okay, again, so why is this cool? Well, regular Roth IRA contribution limits are $6,500 a year. This assumes that you're under age 50 and you can't make catch-up contributions, which are beyond the scope of this video. Roth accounts are never taxed again, assuming you make a qualified distribution. And so to max out tax savings and then grow Roth account values much faster than usual is a great benefit. So again, if you're traditionally limited to $6,500 a year going into your Roth account, but you're able to fund the pre-tax dollars from your traditional regular employee deferral, and then you can grow your Roth account by all these after-tax dollars, that's just a huge win for you in terms of accumulating tax-free wealth for the long run. So some of the disclosures I want to show here, the match that I illustrate in this video, it's based on the company saying basically matching 4.5% of 6% of your salary if your salary is $375,000. Essentially, I was trying to define what might be the largest match that you could get under current contribution limits and all that kind of stuff. So it's a totally hypothetical example. That's what the amount was based on, but it's just completely hypothetical. You may have no match, or your match may be completely different than what I'm assuming here. Secondly, you need to consult a tax advisor anytime you're dealing with taxation of your accounts. And finally, all the contribution limits that I've referenced are based on 2023, and they are without considering catch-up contributions for people that are age 50 or over, because once you do get past age 50, these accounts typically do have catch-up features which allow you to contribute more than what I've illustrated here. All right, that's it. Hope it's helpful.